The US housing market is collapsing and this could take down the global economy again. So we know interest rates have been rising. The Fed funds is about to crack the 5% level. And finally, this is affecting the housing market. We are witnessing a real estate collapse in real time as people just don't have enough money to buy a new home. And in a shocking report by Bloomberg, the US housing market posted a $2.3 trillion drop, the biggest since 2008. And let me repeat this price drop was almost as bad as the '08 housing crash, the one that took down Lehman Brothers. Now, after peaking at $47.7 trillion in June, the total value of US homes declined by 2.3 trillion or 4.9%. That's the largest drop in percentage terms since the 2008 housing crisis when home values slumped by 5.8%. Now, this is serious news because most of people's wealth lies in real estate. And I can bet for most of you watching, at least half of your net worth is probably tied up in your home or mortgage. So just imagine what happens when the majority of people see their wealth take a hit, they get frightened and they stop spending further. Yes, it's only paper wealth. It's not a tangible loss until you sell, but boy does it hurt, it messes with your mind. And we can see that the US housing market getting smashed hard in 2022, reversing the gains from the pandemic years of 2020 and 2021. Yes, home values are still 6.5% higher than a year ago, but that tells us there's still more downside to go. But Powell isn't done yet with his rate hikes, guys. He is going to hike further and real estate has a lot more downside to go. In fact, my base case scenario for the Fed funds is a bare minimum of 5% and up to 6 or even 7%. And here's the thing we have to realize, real estate is the recession canary in the coal mine, guys. It's a very slow reacting market, and if things are finally catching up, we need to pay attention. Now, the real estate crash isn't uniform throughout the entire United States. There are some places that are still booming while others are slumping. We know the Bay Area and New York are getting clobbered with crashes as high as 6.7%. But there's still some towns in Tennessee and Florida where prices are still staying strong. And what I'm saying is that the housing market in general is crashing, not specific areas. It's not looking good, and we have to understand why the carnage is happening. Now, that's the reason why the median US home price has crashed by over 11% since the peak in May. And it's because mortgage rates are at crazy levels. 6.3% in December and rising to 6.71% just last week. And the problem with US mortgages is how it's a winner-take-all market, right? And it all has to do with the insane 30-year mortgage length. Now, if you're outside of the United States, like in Singapore or the UK, mortgages are fixed for the first 3 to 5 years only. Then after that, it is pegged to a floating rate. So you might get screwed for the first 3 years at 7%, for example. But if the Federal Reserve eases and lowers rates, the mortgage rate should reflect that, right? Should reflect that. It will drop accordingly down to 5%, 4%, or 3%. So it's not that bad. But in the United States, the moment you take out a mortgage at 7% today, you are screwed for the next 30 years at 7%. It's like a prison sentence. And we know the Federal Reserve will lower rates sooner or later. We can't have the Fed funds at 5 or 6% for the next 30 years. The economy will be in an eternal depression. You know this is a one-way bet that you will lose big time. And which rational-minded person is going to jump into the fire for 30 years straight? And that's why home prices are starting to collapse, starting to come down in the United States. But the other problem is getting financing itself. Will the banks and mortgage lenders even entertain you? And let's say you earn around $6,000 a month, which is around the median salary of the average American, and you want to buy a home that costs around $500,000, assuming you have 100 grand set aside for the down payment, typically around 20%. Now, at a 3% rate, your total monthly payment is slightly more than $2,000, putting your debt to income ratio at 33%, and that's high, but you can still qualify for a loan. Anything above 40 or 45% is considered a high-risk borrower. So just imagine, guys, if your mortgage rate is now at 7%, your monthly payments are now above $3,000, putting your debt-to-income ratio at 50%. And that's why mortgage lenders aren't loaning money. They're afraid of defaults happening, especially after the housing crisis in '08. So on one hand, right, you have fewer loans being issued and also a 30-year prison for homeowners. People aren't buying unless they really need a place to stay. And guess what? This contagion is going to spread into the general economy, starting with the big banks. And we know banks like JP Morgan and Wells Fargo, they're downsizing their mortgage departments because it just doesn't make sense to take on the credit risk, right? But is there a safer way for the big banks to make money? If they flee from the traditional home loan business, how are they going to survive? Well, this is where Main Street once again gets screwed and Wall Street gets all the benefits, and it's courtesy of our best friends, the Federal Reserve. Now, I'm sure you have heard of the reverse repo market, and that is where the Federal Reserve sells short-term treasuries to the big banks, right? They take their cash and buys them back plus interest down the line. And in other words, the banks park their cash at the Fed for free yield. It's free money, and guess what? The reverse repo rate is a crazy 4.3%, and that's even higher than the 10-year treasury yield, which is just hovering above 4%. And we can see the reverse repo facility at an insane $2.1 trillion multi-year high. Banks do not care about the mortgage market anymore. Why deal with the risk of loan defaults and pesky customers giving you problems when the Fed is literally giving you free money without any risk? They are paying the banks billions of dollars to do absolutely nothing. But here's the thing, the Federal Reserve, they have no choice. They need to keep sucking money out of the system to fight inflation. That's the only thing they can do, tighten the entire system. By keeping the reverse repo rate high, they are luring banks in to stop lending and pump their money inside for a huge risk-free rate. But at the same time, this is going to crush the housing market because now banks have a brain-dead decision to make, right? Do I earn free money at no risk, or take a gamble to hire more workers to push out loans for the extra 1 or 2% margin? Now, even the Wall Street Journal knows this is a problem, questioning if the banks will ever take out their trillions of dollars sitting at the Federal Reserve. And that's why the real estate market could be on the verge of collapse. Everyone is afraid, and the Fed has set up yet another moral hazard for the big banks. And it's really shocking that no one is talking about this. And this is where crashing home prices spread to the home builders who are walking away from all the land deals, right? They don't see any incentives in building more homes when margins are getting squeezed, guys. And according to home builder Meritage Homes, their sales orders have collapsed by a crazy 46% in Q4 2022, and revenue has dropped by over 50%. Home builders are businesses trying to make a profit, and what are they seeing now? Rates are going up and people just can't afford to buy anymore. We can see mortgage payments now account for nearly 30% of household income, so people are paying more just for shelter, and we haven't even brought food and energy into the mix yet. We can see investment in residentials dropping below the 2020 levels and looking suspiciously like the big fall just before the '08 crash. Home builders just can't be bothered to reinvest their money back into the housing market. And to be honest, guys, if you're a home builder flush with cash, there's almost no point in building homes right now. By the time you're done with one project, the next one could be selling much lower, but your costs are still the same, they're still high. And the Fed has set up such a perverse system that you might as well just throw your money to treasuries and wait out the crash. Now, the short-term yields are already at 5% for simply doing nothing. So the price collapse we are seeing isn't due to a lack of demand or huge supply of new homes, but the lack of affordability. The cost of borrowing is just too high. And guess what, guys? The contagion is spreading yet again. And that's why the entire financial system today is a beautiful train wreck. Everything is connected together. We now have Credit Suisse cutting their property funds payout as investors are running away with their cash. As much as 13% of the fund wants to exit after valuations were hit by rising interest rates. Now, this will limit distributions to investors to as low as 35 francs a share, down by 40 francs. And the reason is simple. Falling property prices are causing a panic. Investors are heading for the hills, asking for their money back. But it isn't just Credit Suisse. BlackRock suspended withdrawal requests in their multi-billion UK property fund back in January. Blackstone's real estate trust is also hitting its monthly redemption limit. Now, the housing crisis has spread to the financial institutions now. And this is bringing real flashbacks to the '08 MBS disasters, right? And if you're an investor, you're stuck watching the fund crash and burn. That's why we keep saying store some money outside of the financial system. They control your money, and just because you want to leave doesn't mean you get to exit. And the problem with real estate is how illiquid it is. It is not like stocks, bonds, or gold. You just can't go around unwinding your position in a day. It will take months or even years if you are unlucky. But I don't want to be all doom and gloom here. The last time this happened was back in '08, and remember how much money was made. I had relatives making $500,000 on condos 2 years after the market rebounded, right? You could literally buy homes at 20 or even 30% down from the top, and developers were giving discounts to stay afloat. Plus, now you have that double whammy, guys, of higher food prices as well. Everyone is getting poorer, and that means if you are prepared, you won't have much competition. So, if you don't own a home yet, or you're looking to get your first investment property, this could be it, guys. If the market really collapses, I'll be buying as well. And I really think the future is going to be split between landlords and renters in the future. And if you don't own your own home, it'll be near impossible to build wealth. And the problem with renting today is that you build zero equity for the myth of flexibility, right? It's basically embracing the you will own nothing and be happy argument. You mustn't give in to their agenda. And let's say your rent is $50,000 a year, and by some miracle, it doesn't go up, right? You are still losing $1 million in 20 years with nothing to show for it. And deep down, we know home prices are going to be higher down the road. The dollar is going to be debased, housing prices will keep rising over the next 20, 30, 50 years, and homeowners will keep charging higher rent. That's why you got to start saving more money now, save more cash, and get ready if a crash happens. I'm not saying that it will, but that it might. Because what is guaranteed to happen is down the line, the Federal Reserve lowering rates and putting the punch bowl back. People will become speculators once again. The cowboy mentality will be back with low interest loans, and real estate will be on fire again. But let me know what you think. Is the housing market on the verge of a collapse? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these insane times.